Today's topic is income from salary. It is one of the heads of income tax. So, remuneration received by an employee out of employment from his employer is known as salary income. So, here the person should receive an amount in regular periods or for every month from his employer, then it is known as salary income. So the relationship between payer and receiver should be employer and employee. So when the person is receiving money or salary from the employer, receiving person from the other person, the relationship between two persons, employer and employee, then the received amount treated as income from salary. Salary means basic salary plus allowances plus perquisites plus profits in lieu of salary. So all together called as salary. Basic salary means the minimum pay which the designation has eligible, and allowances depends upon the company and the employer, which the employer wants to provide to his employee, and perquisites are the fringe benefits which are given to the employee including his family. It is also depends upon the employer and the nature of business or work they are doing, and profits in lieu of salary. So these are the profits which the person will get at the end of his services or at the retirement of services. So these are all together called as salary. Now next is salary payment methods. So there are three types of methods. According to that, the salary is paid to the employees. First is consolidated pay. Consolidated pay means under this method the employer pays a lump sum money without specifying about any allowances and perquisites. When the consolidated pay is given to employee, cannot have any choice for selecting an allowance or a perquisite. So here in the consolidated pay method, the salary is paid in a lump sum amount instead of periodical payments. So here there is no any chance of selecting allowances and perquisites. So the employee has to accept which is paid by the employer to the employee. Next method is salary with the split allowances and perquisites. So it is completely opposite to the consolidated pay. In the consolidated pay, the amount is paid in lump sum amount, but here in the second method, the salary is divided into periodical payments, and allowances and perquisites are also added to the salary. So in this method, the employee can get allowances and perquisites, but employee will not having any chance to select the allowances or perquisites. It is remain same for particular cadre. So the employee will get according to his or her category. The third method of salary payment is personal choice payback. Under this method, the employer will specify how much amount he wishes to pay for an year at the time of joining the duties and also at the beginning of each financial year to existing employees. that means it changes every year. It's not depending upon the cadre, or it is not a lump sum amount. It will change every year at the beginning, and the change will done by employer. For example, a pay pack of 9,50,000. Under this part, salary, let's say 40% salary, employee can choose allowance and perquisites. So salary structures, allowances, perquisites of two employees, same cadre, not be same. So there will be choice for selecting allowances and perquisites. So it cannot be same for each employee, because in the second method the salary was same for cadre, but here in same cadre and in two different persons are getting two different salaries. So it is a personal choice payback method. So these are the three methods. By using these three methods, the salary is paid to employee by employer. Next is allowances. Allowances is a fixed mandatory benefit given by the employer to the employee for a specific purpose. For example, house rental allowance, children educational allowance. The employee can withdraw the allowance, or he can increase or decrease the allowance amount. So it is a allowance means let's say it's a one of benefit which the employer will give employee for his work, for his service rendered to the company, and it fully depends upon the employee. According to his wish, he can decrease or increase the allowances, or completely he can remove the allowances concept from salary. So the payment of an allowance can be either on account of an agreement or a discretion of the employer. So these allowances are prescribed when the employee is joining into the services. So according to that, prescribed allowances are given to the employee. So from taxability point of view, the employees can be classified two categories. So for allowances, there are two. The taxability point of view, there are two types of employees: special category employees and general category employees. For special category employees, all allowances received by the following person is fully exempted from tax. Allowances received by Judge of High Court and Supreme Court, allowances received by employees of UNO, allowances received by teacher, professor, research scholar from a foreign country which is SAARC member nation. The exemption is allowed for a period of 2 years. Allowance received by chairman, member of UPSC. So above all these persons who are getting the allowances, those allowances are completely exempted. So these employees are come under special category employees. And general category employee, there is a second type of employee category, that is general category employees. From the income tax point of view, the allowances are classified into three types. So in general category employees, there are three types of allowances in taxability point of view. That is fully taxable allowances, fully tax-free allowances, that means exempted allowances, partly taxable allowances, and unexempted amount is taxable. So these are the three allowances for general category employees in view of tax, income tax. Now let's see the fully taxable allowances. So dearness allowances is taxable allowance, and additional allowance, city compensate additional DA allowance is also taxable, and city compensatory allowance is taxable. Marriage allowance, family allowance, meals allowance, servant allowance, project allowance, interim relief allowance, medical allowance, lunch, overtime allowance, warden allowance. So these are the taxable allowance. If any employee getting these taxes, these allowances, those are all taxable. See, fully tax free or exempted allowances. Foreign allowance to the government employees. If any government employee receiving allowance from foreign countries, those allowances are exempted. Any allowance paid by government to an employee working in a foreign country who is a citizen of India is fully tax free. And any allowance paid to High Court, Supreme Court judges, Chief Election Commissioner, Present and former chairmen and members of Union Public Service Commission are exempted. All allowances received by an employee of UNO and diplomatic and consulate staff of foreign government working in India from his employer, if any getting their allowances, they are exempted. Allowances received by teacher, professor, research scholar, a foreign country which is a SAARC member nation, a period of 2 years is exempted. And allowances received by chairperson, a member of UPSC, is also exempted. Now let's see the third typo, that is partly taxable allowances. That means partly taxable allowances means exempted amount is limited amount is exempted, and if the after limit is there any still amount is there, that is taxable. So here 3 different types of categories are there. General allowances exempted with linked with actual expenditure, and exemption which is does not linked with actual expenditure. So here general allowance, here there are 2 types of allowances in entertainment allowance and house rental allowances. These 2 are the partly taxable. Now let's see entertainment allowance from general allowances. Here there is a rule for entertainment allowance because it's partly taxable allowance. So here the rule is unexempted amount is taxable. So if an employee getting this entertainment allowance, the up to limit is exempted. Still beyond the limit, the employee getting the entertainment allowance, whatever the amount is there, it is taxable. So here entertainment allowance is one of the items of deductions allowed under section 16(2) from salary income. So this section is Indian Income Tax Act 1961 under section 16 subsection 2. So according to that this entertainment allowance is given as deduction, but unexempted amount is taxable. It is not fully exempted allowance. So it is not fully exempted allowance, and this allowance may be given for official purpose or personal purpose. So it depends upon the work and employees employee cadre. So according to that it may be official or personal purpose. If the actual amount spent is less than the received amount, then the difference amount is treated as taxable income under allowance. So for example, if an employee getting 1,000 rupees as allowance, entertainment allowance, from that if the employees spent only 500, then the remaining 500 is taxable under income. Entertainment allowance is not an income, but it is taxable. If nothing is mentioned in the problem, then the allowance received is to be treated as personal purpose. Now let's see the steps for calculation. Add the actual amount of allowance received to the salary, writing in the statement under the head of allowances. So first we have to add the amount which is received to the salary and under allowances, head of allowances. Calculate the exempted amount of allowances in the working note. So how much amount is exempted, we have to calculate. Then unexempted deduct that exempted amount of allowance under the head of deductions under section 16(2). Deduction is given to only government employees and state government employees. Those are state and central employees. Let's see deduction process. List of the three following. So from these three, least amount is given as exempted. 20% of salary means basic pay, actual amount of allowances received plus receivable, and rupees 5,000. So from these list of these three given as deduction under section 16(2). The next allowance from general allowances, that is house rental allowance. This is one of the major allowance given by the employer to employee. House rental allowance is allowed as exemption, so it is completely allowed as exemption. But entertainment is not allowed. Entertainment allowance is not allowed as exemption. This allowance is allowed as exemption only when the assessee is paying the rent of the house. So it is only given as exemption when the assessee paying rent. So let's see the steps for calculation of house rental allowance. First, calculate the exempted amount of allowances in the working notes. Add the unexempted allowance to the salary under the head of allowances. If employee residing in metro cities Mumbai, Delhi, Kolkata, Chennai, so let's see how the exemption is given. Actual house rent allowance received by employee from employer, rent paid minus 10% of salary. So the rent paid by the employee and minus 10% of salary and 50% of salary. So least of whichever is less. So least of these three is given as exemption. Employee residing in non-metros, that mean other cities, the actual house rent allowance received and rent paid minus 10% of salary, and third is 40% of salary, whichever is less. So the least is given as exemption for employee under head of house rental allowance. Let's see another example for calculating income from house property. Sri Sundar Reddy, age is 55 years, has two flats, in one at Hyderabad and the other in Hi-Tech City. One occupied by him and his wife and other occupied by his parents and children. He claimed both the houses as self-occupied, but income tax officer asked to opt anyone as self-occupied. They are requesting to advise which flat can be treated as self-occupied. So municipal valuation of first flat is 50,000 and second flat is 96,000. Fair rental value of first flat is 65,000 and second plot is 1,80,000. Municipal taxes 10% for first and 10% for second. And rebate on municipal taxes 10%. There is no any rebate for second flat. And penalty delay in municipal taxes. First, no penalty for first, but there is a 2% penalty for second plot. Insurance premium 30,000 for first plot and second is 28,000. Interest on loan taken to purchase the flat is 2,60,000 for first and 4,10,000 for second. Now let's see the calculation of income from house property. See, computation of Sundar Reddy income from house property for the assessment year 1920. So here gross annual income nil for first flat. If we take one is self-occupied and one is on the rent. So here we are taking first plot as self-occupied and second plot as let out. So gross annual value first flat will become nil and second plot is 1,80,000. We have to less the municipal taxes. So for self-occupied house there is no any municipal taxes, but let out one is 9,000. So total annual value is nil for first flat, but second flat is 70,400. So deduction under section 24, standard deduction nil. There is a standard deduction of 51,120 rupees. So interest on loan taken, that is 2 lakhs for first house and 4,10,000 for second house. So now we have calculate the house income from house, but we are getting losses from both houses. So 2 lakhs from first house and second house is 2,90,720. Now, so total loss is 4,90,720. So working nets, how we calculate those things, and municipal taxes 10% of 50,000, that is 5,000 for first flat and second flat is 9,600. So less a rebate. So first flat has rebate of 500 rupees, so 4,500 and 9,600 for second flat. Actual payment. So rebate in municipal tax, rebate received deducted from municipal tax and net amount paid is deducted from gross annual value. So penalty on municipal taxes is not allowed as deduction. Gross annual value is higher of the following. So municipal rental value is 9,60,000, fair rental value is 1,80,000. So standard deduction is 30% of 1,70,400. So 51,120 is the standard deduction. So interest on loan for let out house, any amount is allowed at deduction. For self-occupied house, deduction allowed up to 2 lakhs. So showing less income or more loss is beneficial to assessee. Loss from house property can be set off against the income from the other heads. Now let's see in the second option. When first house is let out and second is self-occupied. So gross annual value first is 65,000, municipal taxes are 4,500, the annual value is 60,500. So standard deduction under section 24, standard deduction is 18,150 rupees. Interest on loan is 2,60,000 for first house and 2 lakhs for second house. So loss from the house property, both are getting losses. 1,17,650 from first, 2 lakhs from second. So total loss is 4,17,650. So the gross annual value is higher of the following. So municipal rental value is 50,000, fair rental value is 65,000. So standard deduction is 30% of 60,500, that is 18,180. So decision on comparing both the option, it is preferable to claim first flat as self-occupied. Now let's see another example for calculating income from the house property. So here on 5/11/2015, Sri Vaman Das and his younger brother Sri Narsingh Das jointly purchased a house in Vijayawada for the price of 36 lakhs. Out of this, Syndicate Bank sanctioned a loan of 21 lakhs at 9%. Outstanding loan amount is 20 lakhs. The house is let out on monthly rent for 15,000. Fair rental value is 12,500 per month and municipal rental value is 1,60,000 per annum. And standard rent determined by the rent controller, that is 1,70,000 per annum. So expenses are incurred during the previous year 18-19. Repairs 2 lakhs. Loan taken 10% from Cooperative Housing Bank. Interest on the loan is not yet paid, and the penalty on interest is 1,000. Municipal taxes are payable half yearly 3,000 for the first 6 months. Taxes are paid in time and received 5% rebate, and for second half payment is delayed and penalty interest is 200. Compute income from house property, Mr. Vaman Das and Narsingh Das. Now let's see. Now, computation of Sri Vaman Das and Mr. Sri Narsingh Das income from house property for the assessment year 2019 and 20. Particulars: gross annual value is 1,60,000 and less municipal tax is 5,850. So annual value is 1,54,150. Deduction under section 24. Standard deduction is 46,245 and interest on loan 2 lakhs. So total deduction are 2,46,245 and loss from house property is 92,095. So let's see the working notes. Calculating expected rental value. Municipal rental value is 1,60,000. Fair rental value is 12,500 per month into 12 months. So 1,50,000. So the expected rental value, annual rental value is expected rental. So standard rent is given. So expected rental value 1,60,000 and standard rent is 1,70,000. List of the following. So calculating the actual rental value: 15,000 into 12 months, 1,80,000. Municipal taxes half year 3,000 and rebate 150. So 2,850 and second half is 3,000. So total is 5,850. Standard deduction 30% of 1,54,150, that is 46,245. So interest on loan for repairs 2 lakhs 10% 20,000. For purchase 20 lakhs 9% 1,80,000. So co-venture share in loss of house properties 9,100 will divide by 246,050 rupees for each. Let's see now another example for computation of income from house property. Here Swaminathan, a senior citizen, is working in Jeevan Jyoti Co Limited at Nagpur. Population is 21.23 lakhs. The salary particulars of him are as under. Basic pay is 21,400 per month a year. DNS allowance is 12,500 per month. It enters for retirement benefits. Entertainment allowance is 3,000 per month. Actual amount spent is 1,000 per month. Okay. Unexempted amount is charged under tax. Uniform allowance 15,000 per annum. Actual amount spent on clothes for himself is 12,000. The unexempted amount is taxable. Leave encashment for 1 month is 28,500. Pension from the employer 4,500 per month. LIC under annuity plan 6,700 per month. He is providing with the following: Rent-free accommodation, rent paid by the employer on his house 5,500 per month, and the cost of furniture provided for 3 months is 1,20,000. He is providing with free meals for 180 days during the office hour through paid voucher, and cost of each meal is 65 rupees. Credit card bill paid by the company, that is 28,000. The company presented a gift worth 4,500. The company sold the following assets on 2/2/2018. The motor car for 3 lakhs purchased in April 2006 for 8 lakhs, and laptop for 5 lakhs. Laptop for 5,000 purchased in August 2017, 1,20,000. So they are asking to compute the income from salary for the current assessment year. Now let's see the calculation. Now the computation of Swaminathan's income from salary for the assessment year is assessment year 2019. Salary, basic pay is 21,400 per month, 2,50,800, and leave encashment is for 1 month 28,500. Pension from the former employer is 4,500 per month, that is 54,000. Allowances, DA at 12,500 per month, that is 1,50,000. Entertainment allowance is 30,000 per month, that is 36,000. Uniform allowance, he received 15,000 and he spent only 12,000. So unspent amount is taxable, so those are 3,000. And perquisites, rent-free accommodation is 69,000, and free meals is 2,700, and credit card is paid by the employer, so it is taxable 28,000. Sale of laptop is 55,000, and sale of car is 2,12,000. So total income from salary is 8,95,000, and deduction, standard deduction under 16(1)(e) 40,000, and profession tax under 16(3) 4,200. So total deduction, after deduction, the income from salary is 8,50,800. Now let's see the working notes, how these values are calculated. So pension from the former employer, the income from salary, B from LIC, A from the former employer, and B LIC under annuity income from the other sources. So rent-free accommodation, first calculating the salary, basic pay is 2,50,800, DA is 1,50,000, and entertainment allowance is 36,000, uniform allowance 3,000, and leave encashment 28,500. So total salary is 4,74,300. Now calculating the value of unfurnished accommodation. Hired accommodation, population of the city is more than 20 lakhs, so perquisite value is the list of the following two amounts. Rent paid by employer is 5,500 for 12 months, that is 66,000, and 15% of salary, so that is 71,145. So list of the following is given as exempted. So value of unfurnished accommodation is 66,000, and we have to add the furniture value 1,20,000, 10% for 3 months, so that is 3,000. So total free accommodation value is 69,000. Free meals, actual amount spent 180 days into 65, 11,700, but only 50% for meal is given as exempted. So exempt 180 into 50, that is 9,000. So unexempted amount is taxable, that is 2,700. So the gift cost is less than 5,000, so hence it becomes the tax-free perquisite. So professional tax, the actual amount paid will be allowed as deduction. So 350 per month, total is 4,200. Now let's see the sale of movable assets. Laptop cost is 1,20,000, less depreciation 50%, that is 60,000. The book value of on the date of sale is 60,000, less sales price 5,000. So perk value is 55,000. Now sale of car cost is 8 lakhs, less depreciation 20%, 1,60,000, that is 6,40,000. Again we have to deduct the depreciation for 2018, 17 and 18, that is 1,28,000. After that the book value of on date of sale is 5,12,000, though, so less the sale price 3 lakhs, and perk value is 2,12,000. Depreciation for the year sale of is not taken. So this is the Swaminathan income from salary.